Hello, everyone. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 14th. I hope you are having a good weekend. I hope you had a good trading week, and I appreciate you coming to my weekend review podcast. In this podcast, we first of all are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the trades that I entered, all the trades that I exited, and also the current positions that I have. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the combination and confluences of signals were happening at the same time that made me decide to get into the trade, how I'm going to position size, how I'm going to place my emergency stop, how I'm going to place my end of bar stop, how I'm going to take partial profits if that particular trade goes my way, and then ultimately how I am going to exit the trade. So when I entered, why I entered, and again, most importantly, how I am going to manage the trade going forward. After that, we're going to talk about trader psychology, a little bit about trader psychology. Trader psychology, really what it really comes down to, the way that I look at it, and in my opinion, is creating a plan, creating a trading plan, and then following that trading plan. Most important thing in trading is to have a plan and then to follow it. You know, a trading plan doesn't have to be complicated. It can be quite simple, and keeping it simple, it is not a bad way to go with trading. It doesn't have to be designed by computers or PhDs, or it really doesn't. What it comes down to is waiting, being patient, looking for support, having a good risk to reward ratio, and then getting out when you're supposed to and stay in when you're supposed to. That's really what trader psychology comes down to. But the problem is, you know, maybe the particular market closes below a stop. People don't want to get out for whatever reason. They stay in, then it keeps going down and it keeps going down. And, at some point you get into the mindset of, gosh, it can't go any lower, can it? Yeah, of course it can. But would you have been happy or glad that you had gotten out when it originally got to your stop? Yeah, of course. Been through it. I've been trading over 30 years. Been through it a lot of times. So it's following your rules, especially to the downside and especially to the upside. A lot of people exit their trades too early. So it's easy to create a plan when the market's not open, the lights aren't flashing. But when the lights start flashing and you start making money or losing money, then the emotions get mixed up in it all. And the whole takeaway here is create the plan and then follow the plan. You're going to be a much better trader and you're going to make much more money. Okay, after that, we are going to go. I went down through my master watch list last night, both on the daily time frames and excuse me, on the weekly time frames, and I have identified some potential symbols for next week that I'm interested in. They're not where they need to be yet. If they were, I probably would have already taken the trade, but they're close. They're in the neighborhood of some potential good areas. And what am I looking for when I say areas? I'm looking for confluences of signals, whether those are major moving averages, whether those are bullish order blocks, whether it's a 30 RSI reading, whether it's a double bottom with bullish MACD divergences or ATR divergences or RSI divergences, and ideally all of those things happening together. The more signals, the more confluences that you have that happen at the same time, the greater the chance that you're going to have a profitable trade. Doesn't mean that every single time it's going to be a profitable trade. You can have the best setup in the world, and it can still fail, obviously. But I don't look at just one trade by itself. I look at 100 trades, 1,000 trades. If I took this trade 100 times, how many times would this trade be profitable? And that's how I look at things, and that's how I suggest that you look at them too. If you have a losing trade and it was a good setup and a losing trade, well, don't let that dissuade you from taking the trade the next time. Because, for instance, take that trade 100 100 times, okay, 74 times that's going to be a winning trade, right? And the rest is not, but that's okay. You know, so we're going to talk a little bit about that in trader psychology, actually, the expectancy. But so, like I said, I have identified some potential markets for next week that are kind of getting close to some confluences, and I'll go through those, and hopefully that will be helpful for you. And if you do find help with that, or some value with that, or anything that I discussed today in the podcast, I really would appreciate if you could hit the thumbs up button. It does really help the channel, lets YouTube know that there's some valuable content here. And if you're not a subscriber, that'd be great if you could become a subscriber as well. All right, so let's get this U.S. legal disclaimer out of the way, and then we're going to get rolling. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started on my current position. So this is a position that I took here, a long position that I took on the 11th of June here at 301.61. This is McDonald's, MCD. So nice confluence here. Actually, probably all in all, my favorite trade setup. It's a combination of two different signals, and like I've mentioned multiple times today, it's the confluence, it's the combination of signals coming together. Let's first start with this green box. What is this? This is what's called an order block, everyone. This is what's called a bullish order block. And what makes this a bullish order block? Well, for a bullish order block to be created, you need to start with some type of pivot low. Here's a pivot low over here, followed by a pivot high, followed by another pivot low that is lower than the first pivot low, and then the price has to rally and take out that swing high. This changes, big picture, this changes the market structure from a bullish market structure, or I'm sorry, from a bearish market structure to a bullish market structure. And when you change, as soon as you change to a bullet market structure, I go down and I look for the lowest bar close before market structure change. Market structure change here. Swing low, swing high, swing low. Took out that first swing high, which changes it to a bullish market structure. The lowest bar close before market structure is here, the high and the low of this bar. And that is what we have, the high and the low of this green bar going forward in this green block. So this is what is considered the order block. So I kind of like to look at it like this. When we were down here, keep in mind, people were buying down here, and then we had this fairly big rally up. Well, in hindsight, the people that were buying here, if you look at it from this perspective, that was some smart money that was buying this area clearly, right? Well, when we come back down into this area, this was originally smart money in hindsight. Is it smart money again? Maybe, maybe not. Things can change. But in general, after you have broken market structure to the upside and you come back down to where the previous smart money was buying, more than often, it tends to at least stop going down there or to rally. So after we have a market structure break up, I like to see it, I like to wait until we come back down into this order block. Now, sometimes order blocks are very wide, sometimes they're very narrow. When they're very wide, I need to have some kind of defining line in the sand that gives me a better risk to reward ratio, because some people trade order blocks where if it comes down and rejects the high of this order block, they get in and their stops at the very low of the order block. Well, that just doesn't work for me. That is way too much risk. So my favorite setup is when you have a bullish order block like this, and then you have some kind of other support level inside of the bullish order block. And here is the 200-day moving average. All right, so if you've taken my course on the deep dip buy, or I have students and I teach deep dip buys all the time. Deep dip buy is a stand-alone strategy, and the deep dip buy includes using the 200-day moving average, the 250-day moving average, the 300-day moving average, or the 30 RSI level, or a conjunction of both. Well, here we go. Here is the 200-day moving average, but it's not, 200-day moving average is great. It's fine. It's a legitimate signal, but because it's living now, because this 200 is located inside of this bullish order block, it makes for a better setup, and it gives me a line in the sand. If my if the price of the stock is over the black line, if it's over the 200-day moving average, I'm staying in. If it closes below, I'm out. But it gives me a very well-defined level. I'm in above, I'm out below. So let's go to where I took the trade. So I took the trade here on the 11th at 301.61. Why? Well, because we had an intraday rejection of the 200-day moving average. On the day that I purchased it, during the day, it actually went below the 200-day moving average and then closed above. That's the entry signal, one of the entry signals that I am looking for. In addition to that, it also rejected the negative third ATR channel. But you can see this here. 92% of prices, when they get to the negative third ATR channel, tend to stop going down, go sideways, or go up. So that was another confluence to the entry. So rejection of the 200-day moving average inside of the order block, rejection of the negative third ATR channel, and cherry on top, we had a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. I use V1s and V2s as additional entry signals all the time. If you'd like to learn more about V1s, V2s, I have a video, a YouTube video that you can go check out on my YouTube channel in the lessons playlist. So a lot of confluences here, great confluences, really. Doesn't mean it's going to be a profitable trade though, right? So, okay, so I get long here, 301.61. So the first thing, and I'm spending more time on McDonald's. I won't spend as much time when we get to the other trades, but just want to kind of give you the lay of the land, how I look at things. So anyway, you see why I entered the position, all right? So the first thing I have to decide is, how many shares am I going to buy? This is a function of two things. One, how much do I have in my trading account? And two, what is the value of the two ATR? You can see right now the value of the two ATR is 849. Average true range just means what is expected to move in any one day. I take that value and times it by 2. And that is what I use as my emergency stop and to position size. So let's just say I have a $100,000 trading account. I take 1% of that $100,000 trading account, which is 1,000. If I have a $200,000 trading account, 1% is 2,000, right? So works with anything. Million, it's 10,000. So $100,000 trading account times 1% is $1,000. I take the $1,000, I divide it by the value of whatever the 2 ATR is on the day that I get into the trade. So $1,000 divided by 849 tells me to buy 117.78 shares. Okay, I'm just going to round that to 118. So I am buying 118 shares. This is the correct amount of shares, the way that I trade, to buy based upon one, my trading account, and two, what the volatility of the market is. If this number is very large, dividing it into my maximum allowed risk, if volatility is high, it's going to have me buy fewer shares. If volatility is low, it's going to have me buy more shares. And that is the way you're supposed to do it, right? A lot of people do not adjust their position sizes based upon the volatility. And if you do it this way, if you do it the way that I do, using the 2 ATR, that's the magic formula. The 2 ATR will automatically adjust how many shares you buy. More volatility, fewer shares, more volatility, more shares. Okay, so I'm buying 118 shares at 301.61. Now, as soon as I enter, the very first thing I do is I take my entry price and I minus the value of the 2 ATR that I just used, 849. So 301.68, I go down $8.49. That is now my emergency stop. And if I have 118 shares and it goes down 849, how much have I lost? I've lost $1,000. See how that works out? So I know what my maximum allowed loss is going to be by using this. There are times where the market could gap below your emergency stop. That's certainly possible where you could lose more. But the majority of time, I know that my maximum allowed loss is going to be $1,000 because I did the math and I set the levels. Now, the bad news, if you hit your emergency stop, is that you would lose 1%. Never fun, but you can recover from a 1% loss in your account. But the good news is that this emergency stop is only triggered about 5% of the time. The other 5% of the time, your emergency stop or your end of bar stop is going to come into play and get you out before the emergency stop. So where is my end of bar stop on this trade? My end of bar stop on this trade is simply a close below the 200-day moving average. I base all of my entries, all of my exits on the closing price, except for the emergency stop. If the emergency stop gets hit, I'm out immediately, whether that's 1 second after the market opens or 1 second before the market closes. I do not wait for the end of the day. But with all the rest of my signals, I wait for the end of the day. So my end of bar stop will be on this particular trade a close below the 200-day moving average. If it's weak enough to close below the 200-day moving average, I'm out of the trade. But you can see how the 200-day moving average is much closer from a risk to reward standpoint away from my emergency stop. So the emergency stop gets hit about 5% of the time. The other 95% of the time, if I have a losing trade, it will be a close below my end of bar stop, which will be closer. All right. So have the rejection of the 200-day moving average, have a rejection of the negative third ATR channel. This all happens in the order block plus the V1. I enter 301.61. I position size. I place my emergency stop 2 ATRs below my end of bar stops, so close below the 200-day moving average, which is a black line. The next thing I do is I take my entry price, 301.61, and then I look for the value of the 1.5 ATR. The emergency stop was 2 ATR. This is now the 1.5 ATR. I take my entry price plus the value of the 1.5. The 1.5 is 637. So I take my entry price, I go up 637. This is now my trailing stop level. And so if in the future, once I take the trade, if it gets to my trailing stop level, now I go into what is called trailing stop mode. Doesn't mean I do anything. It just means that I'm in trailing stop mode. And that means now in the future, if I have a close below a previous bar's low, I exit half the position. It just tightens everything up. You hear about tightening your stops up, moving your trailing stop levels up. Well, by selling half of your position, if you have a close below a previous bar's low after reaching trailing stop level, it automatically does that. And it's a really good feature of these strategies that I use. And, selling half of your position is one of the only win-win situations in trading. If you sell half and it goes down, you're really glad you sold half. If you sell half and it continues to go up, you're glad that you still have half, right? So that's why I use that. So now, in addition, everything we've talked about so far, the position sizing, the emergency stop, the end of bar stops, going into trailing stop level, these are all considered defensive moves. So if the market moves against me, I take a certain amount of action. But I also like to play offense in my trading as well. And I play offense in my trading by taking partial profits each day if the price has moved a certain amount from the previous bar's close. And the way that I do this on McDonald's here, we'll just do it because this is for Monday morning. I take the closing price, 301.91, and I add to it the value of the 0.45 ATR. So you can see we use the 2 ATR, the 1.5 ATR, and the 0.45 ATR. And the value on the 0.45 ATR right now is $1.91. So I take $1, and I take the closing price, 301.91, and I add the value of the 0.45 to it, $1.91 plus 1.91. My first profit target for Monday is 303.82. So I usually just put a little line here. I said that was 303, 303.82. That is my first profit target. Now, if it gets there on Monday, here it is right here, how much am I going to sell? I'm going to, however many shares I go into the day with, I take 10% of that, and that's how many shares I sell at that first profit target. So if I have 100 shares and it gets to the first profit target, I take off 10 shares as the limit order, right? Now I place 3 of these. So closing price plus the value of the 0.45, 191. My first profit target is 303.82. I just do it again. I take the first profit target, 303.82, plus $1.91. My second profit target for the day, 305.73. All right, that's my second profit target. How much do I take off there? The same amount as I took at the first, right? If it's 10 here and it gets to there, another 10, and I do it one more time. I do it 3 times. 305.7, the second profit target, 305.73 plus 1.91. My third profit target for the day, 307.64. There you go. So those are the 3 profit targets for Monday. If it goes down, obviously I'm not going to hit any of them, right? If it goes up decently, maybe I hit 1. If it goes up really good, I hit 2. If it goes up great, I hit 3. I've hit up to 7, I think. But if it goes down, you don't hit any, and then you redo it the very next day from a lower level. All right. So those are the basics of this particular trade. Again, rejection of the 200-day moving average, rejection of the negative third ATR channel, a V1 entry signal inside of the bullish order block. And you can see on on Friday, when it did go up, and I did hit 1 profit target, so I took some off. I locked in some profit, reduced the position size. So have not got to trailing stop mode. I'm still above my end of our stop. Have not got to emergency stop level. So still, I'm still bullish on this trade. I'm still in the trade, only up 0.10% because of the big reversal that we had on Friday. But nonetheless, nice signal, good example of multiple confluences happening on the same trade. So we'll see what happens. McDonald's up 0.1%. All right, let's go to VIX. All right, this was a really great trade for me on Friday. If you've been watching the podcast, you know I've been talking about VIX for several weeks, and I said, if VIX gets down to the 200-day moving average, which is the black line, that would get me interested in the trade. In addition to that, I was talking about the MACD divergences that we had, and look, if we look over at this level over here, this big move down, look how deep the red MACD bars are. They're very deep. This is a This shows you how much selling momentum is happening. It's a momentum indicator. But we came down very strong, very strong, very strong. MACD lines were very, very deep. Well, look over here, and in the middle we had a bit of a bounce, which turned the MACD bars green, which is required. And then a few days ago, or when I did the podcast last week, we were down in this level here. This level here, the price bars are lower than this level here. Would you agree? But look at the MACD bars. Even though the price is lower, the MACD bars are not as low. This is what is called a double bottom with the bullish MACD divergence. So it's kind of the way to look at it, it's kind of the lay of the land is starting to look bullish because of this double bottom bullish divergence. But even though the lay of the land is starting to look bullish, I still need a legitimate entry signal. And very simple entry signal I have on Thursday. Why? Again, back to deep dip buys. We had a close under the 200-day followed by a close over the 200-day. So I position size correctly, or I entered at 51.25 with the correct position size. My emergency stop is how far below? 2 ATRs. My end of bar stop is a close below the 200-day. Look how close my entry is to the 200-day. If the next day, Friday, it had just closed literally 1 penny below the 200-day moving average, what would I have done? I would have gotten out of the trade, right? I would have gotten out of the trade. So this is a very good example of a really good risk-to-reward ratio. We have the setup, we have the double bottom bullish divergence happening, which caught my eye. We have the 200-day moving average, which is the deep dip buy. And I have the risk-to-reward ratio. Look, it was up 7.8% for me on Friday. Huge trade, huge trade. But I didn't know that was happening. The only thing that I have in my control is I can see a double bottom bullish divergence. I can see a rejection of a major moving average that we are now above it, and we have the support below it. And I set up my trade. And sometimes these things happen, and it's great. So this has been a really, really good trade so far. 1-day trade up 7.05%. Now you can see my orange line up here. What is this? That's my trailing stop level. So I am now in trailing stop level, which means now in the future, if I have a close below a previous bar's low, I will exit half of the remaining shares that I have. And speaking of, you can see I hit 4 profit targets already on Friday as it was going up. So really good trade. Happy for that, and I was happy that I could show you this because it's just from a teaching perspective. It's a great teaching perspective of looking at the lay of the land, double bottom bullish divergence, major moving averages here, and most importantly, the signal, the close under to the 200, close over the 200, giving me a very, very good risk to reward ratio. So VIX up 7.05%. Amazon. All right, Amazon is so far underwater. It's a losing trade. Coming back a little bit because the market's coming down. I entered Amazon here on the 16th, excuse me, of May, because of these 3 bars here in the red. What are these? This is called a bearish island reversal. There's abandoned babies, and then there are island reversals, both bullish and bearish. This is a bearish one. Why? Well, because we gapped up, then we had some sideways motion, and we gapped down. When this formation happens, more times than not in the future, when you look, it will be lower. If you have a bullish MACD divergence and you look into the future, more times than not, it will be higher. So an abandoned baby consists of 1 bar. Here's one. Here's a bullish abandoned baby here. It gaps down, immediately gaps up. More times than not, you look in the future, it will be higher. Was it higher? Yes, it was. Here, the bearish island reversal, more time when this particular pattern happens, more times than not, when you look in the future, it will be lower. But this is one of the times, so far anyway, where it is higher. So I got short here at 205.90. Now, when I use an abandoned baby or I use an island reversal, I don't take partial profits. I don't have an emergency stop. I don't have an end of bar stop. Well, actually, I do have an emergency stop. But on these particular type of trades, I make them very simple. I place a 2 ATR stop above me and a 4 ATR profit target below me, the profit target, because this is the short position. So if I'm wrong, I'm going to lose 1%. If I'm right, I'm going to make 2. So it's a set it and forget it trade. Just put it in the system. Obviously, eventually, one of these two are going to get hit. But I like the odds on my money because of the structure and the pattern. I know more times than not in the future this will be lower. If I take a bullish abandoned baby, I know more times than not this is going to be higher. So I just don't get in and mess with it very much. I just say, okay, great. I'm willing to lose 1%. If I'm wrong, I'm willing to make 2% if I'm right. And if you're getting more odds on your money, if you're making 2 times if you're right compared to 1 time when you're wrong, but the chances of being right are much higher than being wrong, it's a pretty good proposition, right? So anyway, you can see we got very close to my stop up here, but we didn't hit it yet. So I'm still short on the trade, and this particular trade currently down 2.89%. All right, let's go to UNG. UNG, you can see there's a green box down here. So what does that mean? That means it's a bullish order block. What defines the bullish order block? We have a swing low, followed by a swing high, followed by a lower swing low. We have a rally that takes out that swing high. This changes market structure to the upside. And this, as soon as this happens, this defines where the order block is. The lowest bar close before market structure change, the high and the low of that bar, going out into the future. If you have a pullback to that area, that is the place that I want to buy. If you look here, when this was when the price was way up here in the 19s, you can look back in perfect hindsight and go, oh yeah, smart money obviously was buying here, right? When it's this high, you can look back and go, yeah, clearly the smart money was buying here. So if we come back down to that smart money area, I may consider to look to buy again. Well, it's exactly what I did here on the 19th of May when we came down and rejected the high of this very narrow order block. I got long here at 1566. I position size correctly. I placed my emergency stop 2 ATRs below. Where's my end of bar stop? A close below the low of the order block, 1504. I placed my 1.5 ATR trailing stop level 1.5 ATRs above. Again, on a day-to-day basis, if the price moves up at least 0.45 ATRs, I'm going to start taking profits. And the very next day was a huge rally, right? I bought it right at the low, huge rally, multiple profit targets, and now I'm also in trailing stop mode. Now I'm in trailing stop mode. It means that if I have a close below previous bar's low, I'm going to sell half. Well, that happened 2 days later when we closed below a previous bar's low. After reaching trailing stop level, I locked in half of the remaining shares that I had for a gain of 6.01%. We had a day up. After that, we had a day up. I took some more profit targets. We came right back down to the bullish order block, and it does not want, at least so far, has not wanted to go below that area. Then we rallied. We had a big day up, hit multiple profit targets here, hit some more profit targets on this day. And then we have come down, we've come down. We got almost exactly to my entry price again, and that's where it bounced. So the remaining shares that I have on UNG up 4.28%. All right. Okay, so those are the current open trades. McDonald's up 0.1%. VIX up 7.05%. Amazon down 2.89%, and UNG up 4.28%. I did have a trade on gold that I had to exit on Friday. Gold just too strong. You can see I have a bearish order block up here in the red. What makes it a bearish order block? Well, we have a high, swing high, followed by a swing low, followed by a higher swing high, and then we have a structure break to the downside, which defines this bar here, the highest up bar close before market structure change defines the order block. And so I did get short here on GLD on the 5th of June when we rejected the bottom of the order block. I got short here 309.30, placed my emergency stop 2 ATRs above, and on Friday my end of bar stop signal triggered because we closed above the high of the order block. So they don't always work, and the main thing is when you have a loss, don't fret about it. Just get out, right? There's many other trades to come, and just pat yourself on the back that you followed your rules. Down 2.19%. So I am out of gold. The bearish order block was not strong enough against the bulls, and it closed above. So basically it told me that I was wrong, right? It told me that I was wrong, and if it's wrong, it's wrong. I say, okay, I get out, and I just move on. All right, so that's GLD with a loss of 2.19%. Okay, now those were the daily trades. Let's go to the weekly trades. So weekly bars close on Friday. I make all my buying and selling decisions on a weekly bar based on the close of the bar. Okay, I shorted QQQs last Friday, 2 Fridays ago, on the 6th of June, at 529.92. Why did I do that? Well, you can see the red box, the red bearish order block. What makes this a bearish order block? We had a swing high, we had a swing low, we had a higher swing high, and then we took out the first swing low dramatically, which now defines this highest up bar close before market structure change as the bearish area or the supply area. So you can see from last week I drew this red line here inside of the bearish order block. Why did I pick that? Well, I picked that because here on the 21st we had a big down bar. And if you remember, if you have a big down bar and it rallies back to halfway of that big down bar, that's generally some inherent resistance. And so I wanted to have some kind of defining line inside the bearish order block so I didn't have to use the bottom and the top of the order block. I wanted to have a little better stop, a little closer stop, and this makes sense. So when I got into the trade on the weekly, why? Because it rejected, it got almost to the penny to that halfway of that bar, and that's why I got short. So I got short 529.92. Of course, I placed my emergency stop 2 ATRs above. My end of bar stop is just, or end of week stop in this case, excuse me, is a close above the high of the order block at 538.85. I place my 1.5 ATR trailing stop level there, and look, now everything's set. I cannot control this market, but I know exactly what I'm going to do. If it goes racing up to emergency stop, I get out. If it closes above the high of the order block, I get out. If it moves down next week, the value of 12.14, that's the 0.45 ATRs, what I'm going to do. I'm going to take partial profits, right? If it continues down and gets to my trailing stop mode, now I go into trailing stop mode, and because this is a short position, that means that in the future, after getting to trailing stop mode, if it closes above a previous bar's high, I am going to exit half the position. So these order blocks are pretty strong. They work pretty well. Obviously, they don't work all the time, but this particular trade at the moment, up 0.89% on this weekly short trade. All right, let's go to Nike. I've been in Nike for quite a while, actually, but it's been a pretty good trade. And going all the way back here to April 18th, why did I take this trade? You don't see a green box, so there's not an order block. This is just your basic deep dip buy setup. And I love deep dip buys. I've been using it for years. I teach them for years. I've been teaching them for years. By the way, I have a really good online video course available at udemy.com where I teach you every single step of how to use the deep dip buy. Um, I think it's 9.5 hours long, that course. It's really good. It's super affordable. It's somewhere between $30 and $50, and that course has had like, I think 4.8 stars. So I get a lot of feedback from that from all around the world. But that's a good place to start in your trading, is to watch that video course. So, but I got long here Nike at 55.80. Why? Well, simply on this bar during the week, we went under the 30 RSI, and we simply closed above the 30 RSI. That's the signal. Although there was a supportive signal with a rejection on that week of the negative third ATR channel, this line here. So what was the confluence? Under 30, over 30, and also an under over the negative third ATR channel. So I got long 55.80. I placed my emergency stop 2 ATRs below. Where is my end of week stop on this one? Well, the main reason I took the trade was because it went under 30 during the week and closed over 30 during the week. So in the future, my end of bar stop was simply a close below the 30 RSI. Hasn't got there, which I'm glad, but that is the end of week stop. I placed my orange line up here. That's 1.5 ATRs above my entry. And then the next week, we move up, hit a profit target. Next week, nothing. Next week, nothing. Next week, up nicely. I hit multiple profit targets. Also got to trailing stop mode, which means now in the future, if I have a close below previous bar's low, I'm going to get out of half. That happened the very next week. This is your first close below a previous bar's low after reaching trailing stop level. I took off half of the shares for a gain of 7.2%. Next week, went up again. I hit another profit target. Next week went up again, enough for another profit target. This week went up, not enough for a profit target, and then it has reversed. So not bad. The remaining shares that I have at the moment on Nike up 7.95%. And then last but not least, boy, I've been in this trade, seems like forever, TLT. Let's take you all the way back to when I took this trade. I took this trade back in January 17th. Remember, if you take a trade on a weekly time frame, unless you get stopped out, you could be in this trade for quite a long time, which I have been, which has actually been okay because, TLT pays the dividend. And so I've had the dividend the whole time. But so I did get into TLT at 87.20 back on 117. Why? Multiple reasons, hopefully, right? Hopefully I'm always going to say multiple reasons. Rejection of the top of the order block, rejection of the negative third ATR channel, a V1. I got into trade at 87.20. My end of bar stop is a close below the low of the order block. My emergency stop is here at 81.80, 2 ATRs below. I placed my 1.5 ATR trailing stop level above. Then for multiple weeks, we went up, straight up, hit some profit targets here. On this week, hit multiple profit targets and got into trailing stop mode as well. And then we kind of moved sideways, and we moved sideways. We had a big up week here where I hit profit targets. Thankfully, remember, I'm in trailing stop mode. Then we had that week where bonds just collapsed. And did we close below previous bar's low after being at trailing stop levels? Yes, we did. So I had to exit half the shares for a loss of 0.59%. Not bad, right? Not bad at all. Still actually up on the trade, right? Because I took profits as it was moving up, which is why I'm such a proponent of that. Then we moved sideways. We had an up bar where I took some more profit targets. Then we had a week a month straight down. We're back in the value zone. This week was up a little bit. So, this trade hasn't done much other than pay me some dividends. I was glad that I took some partial profits along the way up here while I had it. So this particular trade, down a little, not a lot, down 1.09%. So those are the weekly trades. Qs, the short, up 0.89%. Nike, the long, remaining shares up 7.95%. And bonds, the long, down 1.09%. So, I've shown you the dailies, I've shown you the weeklies, and if I'm doing my job right, everybody, what you should be seeing are some potential big wins, which I have in VIX, which I have in Nike. You should have some small wins, like I have in McDonald's, like I have in UNG, like I have in QQQ. I should show some small losses, like I have in Amazon, like I had in gold, like I have in TLT. But what you should not see is you should not see any big, large losses, which I don't. So I'm doing my job, right? I'm not always going to show you everything is going to be a positive trade, but all in all, if I'm doing my job correctly, you should see a few big wins. You should see several small wins, and you should see a few small losses. And that's when you know you're trading well. As I'm just showing you the positions here, I was like, oh yeah, okay, well, I did a pretty good job. This is exactly what I'm supposed to do, and that's what's happening. So anyway, I hope that was helpful for you to kind of take a look at these trades, see how I'm managing them. Before we get on to next week's potential trades, let's talk a little bit about trader psychology, shall we? All right, this post is from my good friend Steve Burns. Steve is a great trader. He is a great author. I had a really good conversation with him last week. We were catching up on everything and different strategies and so forth. And he has come out with some new trading books. They're available on Amazon. Go check them out. I've read almost all of Steve's books. They are worth reading. Steve is a great mentor, a great trader. And he told me something I didn't know. I said, how many books have you written? And he goes, I think I've written 37 books. And he goes, that puts me at this as the author that has written the second most trading books of all people in the world. So I think there's somebody, I'm not sure who's written 44, but I'm sure before Steve's done, he will write more than 44 trading books and will become the #1 author of written the most trading books of anyone in the world. So go check out Steve Burns on Amazon. He has many books. I highly recommend that you buy one or all of his books and read them. I have learned a lot. Steve has taught me a lot of things. And so, yeah, I'm a big fan of Steve Burns. But let's see what Steve Burns has to say here. Think in expectancy, not right and wrong. Your next 100 trades matter more than your next trade. And, I tell this to my students, is that, if they get upset about one loss, I'm like, hey, listen, let's look at this big picture. You are going to have losses. Trading is a business. Your expenses in this business are your losses, right? And you're going to have them. It's just like Las Vegas. They play baccarat, they play craps, they play blackjack, they play all sorts of games. Do they expect to win every single hand, roll of the dice? Of course not. They don't get upset because they know in the long run they have a built-in mathematical edge that in the long run they're going to win more than they lose. Trading is the same way, everybody. It's the same as being the casino. So if I have a losing trade, I don't care. I just know for my next 100 trades, the expectancy for me to win more than I lose is very, very high. If you have a good trading approach, you have good risk to reward ratio, all that kind of stuff, I just know. Every time I have a loss, I'm like, okay, great, I'm closer to a win, right? And that's what Steve is thinking. Think in expectancies, not right and wrong, or not wins or losses. Don't think in wins and losses. Think in expectancy. Think of your next 100 trades and what the net is going to be on those 100 trades, not what it's going to be on one single trade. So the takeaway here is don't get upset if you have a loss, right? You can't change it. It's not good for you. It's not good for your health. It's not good for your family or your spouse, right? It's just a necessary thing that's going to happen, that needs to happen. And if you're trading correctly, you're going to have more wins than losses. So anyway, that's what I want to kind of convey to you today. Don't get upset about a loss. Think in the next 100 trades. Think in the next 1,000 trades. And if you have a decent trading approach, decent trading process, then you have an edge built into your system. The edge is going to play itself out. So again, thanks, Steve Burns. Appreciate that. And again, Steve has multiple new books available. Check them out on Amazon.com. All right, let's go over and check out the potential trades for next week. Now, we had a volatile week this week because of the events in the Middle East. And this has given some opportunity from a trading standpoint for some potential trades next week. You know, when the markets start moving up and just grinding up, it doesn't give opportunities for new trades. But when you do have pullbacks like this, it changes things and gives us opportunities. So I'm going to go both on the daily time frame. I have 9 symbols here on the daily time frame, and then we'll switch to the weeklies. But starting with the dailies, look, I have 9 symbols, right? I have 9 potential candidates for next week. There is a chance that all 9 of these could trigger, let's say, on Monday. Does that mean I would take all 9 positions? No. I narrow down. I don't care if all 9 of these trigger. I'm only going to take one. I only take one trade per time frame. And the reason that many people ask me, why do I do this? I said, well, it's very easy. If I have 9 candidates, one of those 9 has got to be better than the other, right? There's got to be one that's the best. And what makes it the best? How many confluences of signals do they have? What is the risk to reward ratio? What do things look like on the higher time frames? I also use higher time frames to look for potential trades. What's the relative strength of that particular symbol compared to the rest of the market, right? It's very important that you can look at multiple candidates and narrow it down to the best candidate. Doesn't mean that candidate's going to be a winner. It just means it has a higher chance than the others. And this is what I this is what I use. This is how I trade. This is what I teach. Right? And by the way, I do teach private one-on-one lessons. I teach people from all over the world. I've actually changed my course. I changed my course to a 20-hour course. For years and years, I taught a 15-hour course, but recently I've changed it to 20 hours. So if you do this course with me, it's once a week for 2 hours for 10 weeks. So we do 20 hours of teaching, instructing, simulation trades, market analysis. So we do 2 hours, we do it 20 times, and I'll tell you, I have turned out some really good traders right now. My student mix that I have right now, doing very well. Very proud of all of them. I see their progress and their success, and I just love to see it. And so if you would like to be a student of mine and like to study with me one-on-one for 20 hours, please reach out. My email is in the link in the description. Just send me an email. We can get the conversation started. And I will teach you a skill that you can use for the rest of your life and hopefully make a nice income. You know, I've been trading for over 30 plus years now. And, you know, this is what I do. This is what I do, and I will teach you everything I know. So reach out, and I would be happy to have you as a student. Okay, let's start with AMD on the daily, Greg. There we go. All right. So what's interesting about AMD here? Well, AMD has a bullish order block below. It's not there. It's not where it needs to be yet, but it does have a bullish order block. Why? Where did the bullish order block happen? It happened here. We have a swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change, when we have the market structure change, it defines the order block, the high and the low of this bar on 523. It's the lowest bar closed before market structure change. So the high and the low defines the high and the low of the green box going forward. Now, there's multiple ways that I could approach this. If we come down and reject the high of this order block, I can take the trade. The order block's not too wide, and I may do that. Or if we come all the way down and reject the bottom of the order block, then I could get in there too. That's my ideal, actually, because the closer we are to the stop, the better the risk to reward ratio. So rejection of the high of the order block would be legitimate. The rejection of the low of the order block would be legitimate. But what I really like is the green line that I drew inside the order block. Why did I draw this here? Well, if you go back, it has to do with this bar. Here we have 3 bars which make a V2. The bar number 2 of the V2, the washout bar, halfway of this bar here holds inherent support. Well, look right here. Proved my point, right? Went up, came down to halfway of the bar on the V2, took off right from there. Will that hold again? I don't know. Possibly, probably more chance than not than it will. So these are the 3 levels that I'm looking. I'm looking for rejection of the high of the order block, rejection of halfway of the washout bar on 523 inside the order block, or a rejection of the low of the order block. So I love order blocks, everybody. I love order blocks, and I love to combine my other strategies with order blocks. But is AMD there yet? Absolutely not. Do I want to get involved with AMD? Absolutely not right now. Not unless AMD shows me that it can reject one of these levels, and then I would consider to take the trade. Alibaba, BABA. Okay, back to my absolute favorite setup. Deep dip buy that resides inside a bullish order block. Well, the order block you can see is this green box. It's pretty wide, right? The high of this order block is 107.21. The low is 97.14. Too wide just to get to buy a rejection of the high of the order block. But again, look, we have a major moving average living inside the order block right here. So if we come down, reject that 200-day moving average, yeah, I would definitely consider taking that trade, because that 200-day moving average gives me a very well-defined line in the sand. If it rejects it, closes over, I might take it. Next day, if it closes under, I'm just out. I'm just out. If it goes up the next day again, I could consider getting in. So what I'm looking for in Alibaba here is a rejection of the 200-day moving average, or if it goes even lower, a rejection of the 250-day moving average inside this bullish order block. Bitcoin, BITO, that is. Okay, well, we are inside of a bullish order block right now. We had a low, swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change, defining this as the order block. Had this on Friday closed above the 200-day moving average, I would have considered buying it, but it did not close above it. So what are my other options going forward? A close above the 200, I would consider that. If we go lower and reject this upward sloping 50-day moving average here, I would consider that as well. Or, of course, just a rejection of the bottom of the order block. And right now, I believe Bitcoin's down over the weekend. So yeah, I'm kind of right now initially looking for this 50-day moving average, a rejection of the 50-day moving average that happens inside this bullish green order block, and the 50-day moving average is 20.59. So that's what I'm looking for. It has to go lower, reject the 50, or go higher, close above the 200-day moving average. Berkshire Hathaway. All right, another nice potential setup here. We have a bullish order block, and we have the 200-day moving average that lives inside of the bullish order block. And we have the negative third ATR channel here, and the 200-day moving average and the negative third ATR channel are dovetailing here. So I am just waiting for some kind of rejection of the 200-day moving average, some kind of bounce, some kind of intraday rejection, or also a close under or close over. I would potentially get into BRKB. Also, there is the 250-day moving average lower in case we go lower, that I could key off as well because that lives inside the order block. The Dow DIA, okay, well, bullish order block. We're not there yet, but could we get there? We certainly could. So I have three options on the Dow. Rejection of the high of the order block, which would be 418.17, the low of the order block, 413.83, or I have the green line in here. Why? Again, that's halfway of the washout bar of the V2 for 1560. So a rejection of the high of the order block, a rejection of the midpoint of the V2 here for 1516. We have the 300-day moving average that also lives inside the order block. That's at 414.56, or a rejection of the bottom of the order block. So somewhere in this area, technically, we could expect a bounce. Google, G-O-O-G-L, bullish order block down here. Not there yet. Will it get there? I have no idea, but if it does, I would consider a rejection of the high of the order block, 168.28, a rejection of the low of the order block, 165.08. So those are the levels that I am looking for on Google. Southwest Airlines, nice order block here below. Nice 200-day moving average, deep dip by 200-day moving average living inside the order block. That's what I'm really looking for. Potentially a rejection of the high, 31.21, rejection of the low, 30.50, but that 200-day moving average in there inside of the order block makes a lot of sense, and that 200 is at $30.76. We're at 31.73. So listen, we could get there. We could certainly get there. So I'm going to be watching that one. Merck. Boy, I was really bullish on Merck. Over here, I actually got stopped out, actually. But now it's finally done what I was thinking it would do. But now it's extended. And I am looking for this order block here. Look, we have a swing low, followed by a swing high, followed by a swing low, followed by a change in market structure to the upside that defines this bar here on the 28th, the high and the low. The high is 77.72, the low is 75.59. But what I really like is the green bar in the middle. What is that green bar? Well, it's halfway of a washout bar of the V2. And also, look, was there support here, sideways motion, before we moved up? Yes. So this is clearly the support level for Merck right now. And so if it comes back to the support level here, great, but it's also coming back to a bullish order block area as well. So I'm looking for either a rejection of the high of 77.72, rejection of 76.35, which is the middle line of the V2, or also a rejection of the low at 75.59. And then let's go to SPY, S&P 500. Well, we have a nice bullish order block, and with a combination of 200-day moving average below. Is it going to get there? I don't know. If it got there, would I be interested? 100% I would. Yeah, 100%. I absolutely would be interested in that level, because we have a swing low, we have a swing high, we have a swing low, we change market structure to the upside, defining this lowest bar close before market structure change. The high 581.81, the low 575.60. That's the bullish order block area. So rejection of the high of 581.81, I could consider getting long there. I could consider getting long of a rejection of the 200-day moving average, which is at 579, or obviously a rejection of the low of the order block at 575.60. You know, interestingly, on SPY, I drew the bearish order blocks above, and then I drew the halfway, well here, I think this was on the weekly, bearish order block, big bar down. I drew the red line halfway through the big bar down, and it's like, if it comes back up to halfway, that's where it's going to find resistance. Look at that, everybody. To the penny. To the penny of where I marked it, that's where the top was. So these order blocks, no joke, man. Yeah, they really, really work. And adding these other, halfway of big up bars, halfway of big down bars really does help. And again, this is what I teach in my one-on-one course. I teach you all of these things, but that did nail it. Well, let's see, the high was 605.06, and I wrote it at 605. So this particular one, it was 6 cents off, but pretty amazing. But now I'm looking to the downside, right? Now we have the 200-day moving average inside of the bullish order block. If it doesn't get there, I'm not going to take it, but if it gets there, I'll consider it. All right, so those are the dailies, and let's get to the weeklies. I've been talking about Apple on the week for many weeks, but it's a good example of everyone of like, look, I know where I want to buy it. 200-day moving average, or 200-week moving average, excuse me, 179. Yeah, I'd be happy to buy it there. We have a bullish order block below. We have a 250-day moving average inside of the bullish order block. But I haven't messed with Apple until it gets there, and that's really what I suggest people do. Look at a chart and go, boy, ideally, where would I buy this? Well, it's easy. I'd buy it at the 200, or I'd buy it with rejection of the high of the order block. I mean, the most ideal spot in the world, the negative third ATR channel, the 250-week confluence inside of the order block. Yeah, buy it all day long at 169.04. But look at the chart, identify the sweet levels, the areas that you would buy, and if it gets there, consider buying it. If it doesn't get there, don't mess with it. Right? So that's what I'm looking for in Apple. Rejection of the 200-week moving average, rejection of the high of the order block, which is about 175.79, or rejection of the 250-week moving average, which is 168.11, or the bottom of the order block at 163.13. Goldman Sachs. Looking for a short on Goldman Sachs, ideal spot, 641. Why? Well, we have a bearish order block, and then we have this big down week the very next week. Remember, if you have a big down week and you rally back to halfway, just like we did on SPY, that's the area. You can see as we've approached this bearish order block, haven't been able to get above there. Right? It's acted as resistance as it should. So next week, if we reject the bottom of the order block, the bottom of the order block on Goldman Sachs is 632.80. I would consider shorting there. I really like shorting the 641 area because it's halfway the big down bar, or rejection of the high of the order block at 656.71. Home Depot. Okay. Green box, green order block, swing low, swing high, lower swing low, market structure change, defining this as your order block area. 353.84 is the high, the low 324.29. And look, we have the 200-week moving average just creeping itself into the order block. Could I buy it off of this 100-day moving 100-week moving average in the order block? I could. What is that? That's 350.56. Yeah, next week if we reject that, I could use that as my line in the sand because it resides in the order block. But ideally, move down here to the 200-week moving average at 323.08. Very unlikely it's going to get there, but if it does, I want to have these levels defined. Russell 2000, IWM. All right, we have a swing low, swing high, followed by a lower swing low, followed by market structure change. Having a pullback here is not unexpected, and we have multiple levels inside the bullish order block. We have the 250, which is 199.41. We have the 200-day moving average, which is 198.39, or we have the 300-day moving average, which is 190.47. So these are all legitimate deep dip buy levels, the 250, the 200, the 300, which in reside inside this bullish order block. So I'm just waiting for rejection of one of those. Last but not least, everybody, Tesla. Tesla was strong this week, actually up. I've talked about this for weeks and weeks and weeks. Tesla had a swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change, making this bar here on the 4th of April, the high and the low of this, the bullish order block. And we have the 200-week moving average residing inside the bullish order block. We also have the big up bar here. If you have a big up bar, a pullback to halfway of the big up bar will add some inherent support. So this is what I'm looking for, everybody. 256. You can see we rejected the high of the order block there. Not surprising, but the risk to reward wasn't there. So this is the spot I love. 256. Bullish order block, 200-week moving average, and halfway of the big up bar. That's what I am looking for there. So I hope that gave you a good idea of kind of how I look at things, how I look for those combinations. Like I said, I would love to have you as a student. I will teach you everything I know. I'll teach you a skill you can use the rest of your life. I'll teach you all 7 of the different trading approaches that I use. But again, I don't just teach you. I teach you, and then we do all sorts of simulation trades where I say, okay, what are we doing here? Do I need to do anything on this bar? What's my plan here, right? And if you do it right, I say, yeah, that's absolutely correct. If you do it wrong, I say, that's wrong because of this. But it's just like race car driver, pilots, they do simulations all the time. And I don't just teach you, but we do simulations, so I know you know exactly. So if you'd like to become my student with the 20-hour course, 2 hours once a week, please email me. We get conversation started. It'd be nice to talk to you. So I hope this was helpful, everyone. If it was, I appreciate it if you could hit the thumbs up button. Please try to go out and do one nice thing for another human being every day. Boy, this world sure needs that, right? If we all did one nice thing every day for someone else, it would really, really, really make the world a better place. If you could try to go out, do one nice thing for an animal today, that would be really nice as well. They appreciate acts of kindness just like we do. And, you know, I was raised with many animals, and they're very near and dear to my heart. I'm getting a little emotional, everybody, because I had a very good dog friend of mine in Colombia. Her name was Gaida. And I learned that she passed away yesterday. And really sad to hear this, everyone. And as a matter of fact, I'll show you if I can. If I can bring this over. Here's a picture of her. They did a little memorial. And my fiance and I, we spent so much time with her when I spent time down in Colombia, and I was just horrified. I had a good cry when I heard that, I'll tell you. It was so surprising. But just want to tell Gaida we love her. Gosh, sorry, everybody. I shouldn't have gone down this road, but I did want to mention her because she was so special to us. So. Anyway, I hope you have a good weekend, everyone. Golly, I apologize about this. I didn't think I would have this reaction, but I appreciate you being here, everyone. I hope you have a good week, and I hope you have a good trading week next week. And if you have any comments or questions, please leave them in the comment section. I'll do my best to get back to you. All right. Sorry about all the emotions, everyone. I didn't think that was going to happen. So I appreciate you being here, and God willing, I'll see you next week. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.